You are listening to ChartingWealth.com's weekly review and forecast for the day beginning Wednesday, the 27th of January, 2016. We always start with the total market, IYY. It's an ETF, an exchange traded fund that tracks the whole market. What do we see going on? Well, the market has been sliding sideways and a little up, still hasn't recovered from where it went down on the last down 2-day candle on the 21st of January. So if anybody's told you the market has recovered, well, that's not happened. It has broken a 14-day down cycle. At least it broke our trend line, but it's not crossed over going up on the 2-day chart. See if that happens. Hasn't happened yet. Like I said, it did break our 2-day trend line, but breaking a trend line doesn't mean that the market is going up. It has gone up the last 2 days, and we could start drawing an uptrend. But until we have a crossover on our MACD, our moving average convergence divergence, and until our derivative oscillator gets much, much shorter and flips over into the green, we are not going to call this a rally back. It is a potential dead cat bounce, and people say, what is that? Well, that's when you have a lot of losses, and then the market sort of digests those losses, sort of like when you take a dead cat and drop it. It will actually bounce off the floor once if you throw it down hard enough, but it won't get up and run away. And that is what we may be seeing. Not calling that, just saying that may be happening. Let's look at our intraday chart. What's happened over the course of the day? Well, we saw the total market move up starting on the 21st. Actually, well, yeah, on the 21st is when it really started moving up, 22nd. Then on the 25th, market moved down and then sort of sideways throughout Tuesday, up a little bit. Actually, it was up 1.5%. Now, it crossed over going up on the 4-hour chart on the 21st, but just because you have a short chart crossing over going up doesn't mean that you've got a market that is going up. We use the short chart as our trigger chart when it moves in the same direction as our large chart. What does that mean for us? That means that if and when the 4-hour chart starts to roll back over and the derivative oscillator is already losing some speed, if indeed it does and it crosses over going down like it did back on the 4th of January, it would then parallel in its down movement what? The big chart, which is still crossed over going down back on the 4th of December, not the 4th of January, 4th of December. What would we do then when that short chart crosses over and goes in the same direction as a large chart? We would get in. We would get in on a virtual trade. The reason we say virtual here is because we do not give trading advice. We're an education firm. We help educate you so you can make virtual trades. And once you make numerous virtual trades and feel very successful and confident, then you can start making your own real trades. We don't give advice on real trades. Now, let's go to SPY. What is that? Well, that's the Standard & Poor's 500, another exchange-traded fund. It tracks the 500 big companies in the S&P 500. What do we see going on there? Looks very similar, as it does most days, to the IYY. It was up not quite as much as the IYY. It's up 1.36%. Again, hasn't recovered as much as it went down, started going down on the 21st of January. So it has over the last 2 candles, so 4 days, actually going on the 4th day on Wednesday, it has been trying to recover somewhat. But let's look at what occurred intraday on the chart. And again, sliding sideways still, some up movement, up above, well, it's trading in sort of a range right around, what is that, 189 and almost 190. So we'll continue to watch. Crossed over going up on the short chart back on the 21st. We're watching for the same thing. If and when it rolls back over and derivative oscillator has been losing some speed, that does not make for a change in trend, but we'll continue to watch and be ready to jump. You might say, wait a minute, how do we make money when the market goes down? Well, there are inverse funds of the total market, and the S&P 500 and the Qs that we're going to next. And you can either stay out of the market, wait for the market to recover, or you can play an inverse game. That would be by something virtually again like the QID, which actually moves in the opposite direction of the Qs. It is an inverse ETF which goes up as the Qs goes down. Isn't that fascinating? In the world we live in, we can make money when the market goes up or down potentially. So what do we see going on in the Qs? Well, that 2-day chart has actually, and the Qs is interesting, it was up not even 1% today, 0.9%, and we have a red open box. Now again, up candle on the 2-day candle for the 25th, and then for the candle on the 26th, again, it's only a partial candle. It'll finish filling itself out on its 2-day period on the 27th, but it is a red open box, an up wick that got pulled down, pushed up by the bulls, pulled down by the bears. But again, that is where it stands. Now let's look at the intraday chart, and we can see again that the market is moving sideways pretty much in the Qs over the last 2 days. So we'll continue to watch and pay attention. Derivative oscillators losing speed. The MACD is still moving up after it crossed over on the 21st, going up on the short chart. But again, short charts don't make for long charts. Till the long chart turns over, we're still in a confirmed down move, and we will wait for the chart to move back over going down and then look for a possible virtual trade going down on the Qs in something like QID. Now, lastly, we are going to range back out to our 2-day chart. We're going to look at gold. I love it. Gold is continuing to move up, crossed over, going up on the large chart back on the 16th of December. What it really did was slide sideways, staying above what we have hoped is going to be the low on gold, which is around $100.50 on our GLD. And again, remember that's 1/10 of the real price of gold. It tracks gold at 1/10. Makes it a hell of a lot more affordable, doesn't it? Well, it has been going up, crossing over back on the 16th of December, slid sideways, and then started an up movement around the beginning of the year when the market itself started to slide in stocks. Gold can be a safety net people run to when the stock market's not doing well, and that's what we've been seeing. Now, if we look at the intraday chart, look at the 4-hour chart, which is a chart we have loved in the past for gold, it has started leading us in the right direction again. Remember, when it started sliding sideways back in December, our chart went out. Our 4-hour chart was not working, but started working again a little bit on the 12th of January in the down movement, and then crossed back over going up on the 20th. And indeed, it has continued up, and we're feeling good about our 4-hour chart right now. That is where gold is, confirmed up moves on the short chart and the long chart. And again, like we said, if you were looking at gold and you saw it cross over back in December, and then you saw it cross over to parallel the up move on the 4-hour chart around the 20th, you would not have done poorly to have gotten in and watched gold march up. So that is what we're looking for when we're looking to do our virtual trades and practice. That is where the market ended on Tuesday, the 26th, as we go into Wednesday, the 27th. Thank you so much for joining us at Charting Wealth. If you don't have our How to Read a Stock Chart video, all you got to do is go to chartingwealth.com, sign up for our daily review, which you've just heard for Wednesday, the 27th of January. When you sign up, you'll receive our daily reviews every day the market's open, plus our weekly review and forecast, plus that How to Read a Stock Chart video, and the layout that we use at freestockcharts.com. All that's available, and you know what the cost is? Priceless. We don't charge you anything. Go to chartingwealth.com. Let us help you. God bless. Wish you the best in your investing and your trading.